G'day investors. Today, January 26, 2021, we're going to be talking about the average down technique, some of the do's and don'ts, and what to avoid when following this process. So what we're going to be looking at the moment, just to do a quick recap of the simple trading strategy we introduced recently to our viewers. If you want to see more of the details of that, look in the links below to look up the simple trading strategy and the average down technique. But today we're going to talk about the average down technique, the pros and cons, and the do's and don'ts. Just to recap our trading strategy, this top chart indicates our profitability, and at the moment, just to zoom out for a moment, this goes back, this is a 15-minute chart. You're looking at the US 500 cash, and it goes back roughly 5 months of data, of bars. So very simply looking at our trading strategy, we enter the market. In this example, we're entering 5 contracts, and that would have entered there, and we're looking at the CCI 100. So when the CCI 100 breaks above 0, we enter. As you can see there, the market went sideways, it dipped, and then recovered, and we closed out there. And the close, again, we're using a close. As soon as it dips below 0 again, it means it's run out of steam. And we close out the contract. And the reason we didn't close out earlier is because there's 2 criteria for our trade. We enter if the profitability is, if our exit price is greater than our entry price and the CCI falls below 0, we close a position. So in this case, because our profitability was in the negative and the CCI closed below 0, we didn't close out. So that's the 2 criteria for exiting a simple entry and exit. So anyway, you can use pretty much any indicator to enter and exit, whatever suits you. I'm using as an example here the CCI 100. Now, the average down technique. Let me just zoom into this one a bit more. This gives an example again. We're looking at the profitability up here. So we started here, and our baseline is 100,000, but we started at our account there with 100,001, 364, and here we finished after the positions were closed with 103,253. So we made about $2,000. So what is the average down technique? Now again, we're using an entry point here as per the single trade for a set of 5 contracts. Now, instead of holding that position until the very end, you could have actually exited above there. But what it does is it says, right, we've gone against this, the price has gone against us, we're going to average down. So we need to look at our entry points. So here the entry point is, we'll calculate a gap that's greater than so many points from the entry price. And that gap equates to roughly 30 bars of data. So we look at the average of that range of data. So if it goes beyond, and that's what this calculation down here shows. So if you look at down here on the blue line, it shows the overall average is 34 points. So we're saying 2 times the overall average, and the points difference between the entry there and our next entry, I should say, was 105 points. So anything greater than 70, which was 2 times 34, so anything greater than that, we would have entered our second trade based on the criteria, so 2 times our gap. Now, as you can see here, these bars, each of these steps represent additional contracts added. So we entered our first trade there, we entered our second trade there, a third trade, and our fourth trade. Each time you enter this averaging down technique, the overall average price drops, and that's why after our last entry there, the price recovered. We got out with, I'll just hover over that, you can see 20 positions were opened. Okay, and we closed out with a profit at that point there. So you can see there, we started off at our account value at 1364. We closed out at 3253. So I made a nice little profit in those few days of trading for the average down technique. So that's our strategy for single trades and for multiple average down trades. Now, the key of this video is to explain the pros and cons and why we're using the gap the multiple gap process and not just entering anywhere, any willy-nilly. So to jump to a different chart to demonstrate that, here I'm looking at, let's go back to, I'm looking at 3 different programs, and I'll explain what those programs are in a minute. And let me explain in relevant terms to the daily chart, which gives us a bit more history. And you can see here, we're using this program, 388. And what I've done, set up a spreadsheet here. So looking at all these different indexes, Aussie 200, US 500, gold, FTSE, Germany, China, and testing against that program, doing the same number of indexes against that program and the same number of indexes against that program. We're looking at the 15-minute chart. What we do then is we record the revenue and the drawdown. Now the revenue and the drawdown, let's go back to the 15-minute chart. So again, as I said earlier, in the 15-minute chart, our data goes back roughly 5 months. So from when we started trading back here, when the account was at 100,000 baseline for each of these points, and we're finishing up where it is today. And you can see there, the top chart shows 108,820. So we've made $8,800 in that 5 months for this trade, this program. This one made 4,974, and still this one's live. Obviously, we're still live, and this one's making so far 4,500. Why don't we automatically go to this one if it's more profitable? The reason is we look at, as well as the profitability, we look at the drawdown. So for each of these programs, it calculates the drawdown. So let's look at this one first. This one's making $8,800 in the 5 months. But the drawdown, if you look at the detailed report, is 7,814 Aussie dollars. These are all in Aussie dollars. This one is making 4,900, and our drawdown is 4,600. And lastly, this one's making 4,500, very similar to this second one, and this drawdown is 31.92. So what does that all mean? Well, I've prepared a chart here earlier. So I've collected the revenue. So remember the revenue, and we're looking at the US 500 here. So if you look at the revenue here, 88.15. Again, this is live, so the final data here will change somewhat, slightly. 88.56 is our revenue when it was recorded. Our drawdown was 78.14. So our drawdown for this program, 78.14. And what that 78.14 means is each of these we're trading 5 contracts. So at this point, from the highest high to the lowest low is called a drawdown. So roughly speaking, let me just draw that on the map, on the price chart. I'll use the ruler. So roughly, let's say that was the highest point, about there, and that was the lowest point. So it's roughly $7,800 in drawdown. That is the biggest drop of profitability, if you want to call it that. So it's the biggest drop in profitability, and that's called a drawdown. And we recorded it at 78.14 is the exact number. The same applies for these other charts. So just very quickly demonstrate that here. So let's assuming that was the highest point there. So the lowest point there is 4,600. And we recorded that for this program, 46.33 was the exact number. And the last program for the US 500, profitability is 45.56. Today it's 45, at the moment it's 45.18, but we recorded the drawdown at 31.92. So again, we're looking at each of these, for each of these programs, recording the revenue and the drawdown. So once we've recorded all those, this next chart, and again we're looking here at the index version of it. So looking at the index version, you can see there the total revenue for all the index, for all those indexes for the 390. That's what that represents. was 65.13. If you look at that sum down here, 65.13. That's represented by that 65.13 there. It just sums it all up. The drawdown was 52,737. Drawdown was 52,737. Okay, so we do the same for the other programs as well. That's what it's summarised. Lastly, we do a quick calculation. The revenue divided by the drawdown gives us 123%. That's what the calculation is. C16 divided by D16. So the higher number, we're looking at the higher number the better in percentage terms. So you can see here in this example for the indexes, the index for the 389 program summed a total, if we traded all those indexes, the drawdown was 32,200 and the profitability was 53,494, so i.e. 166%. This was second best at those values, and this was last because we had a relatively high drawdown even though the revenue was the highest. So what we're trying to do is avoid a very low percentage in terms of revenue over drawdown. So that it hopefully explains the drawdown and the revenue process. So why are we looking at these programs in that respect? You're looking at these values here. The reason is, looking at the graphics here, you can see here the preferred program we're choosing at the moment, and I stress at the moment, and I'll explain what that means a bit later. Although we entered at the same period for all three programs, you can see here this one averaged down a lot less in terms of contracts. This program is the same as this one, except we've taken away the gap, i.e. remember I said earlier there's a certain gap we have to meet before we re-enter. This one entered. You can see here the black arrows is where each of those entries were made. The brown arrows, there's quite a few in there, were entered in bunched up there. So we don't really want to enter those in such a short time period, because we're entering in values that are not necessarily adding value. They're creating a bigger drawdown than what we really can afford possibly. So here you can see there each of those steps we're adding positions, adding an extra 5 contracts. Until we're here, you can see there we've added a total of 45 contracts before we closed out. Here we've added a total of only 20 positions. So why is that important? Because if we get stuck in a price drop, a dramatic price drop, we don't want to get caught with our pants down. Let me show you the daily chart version of these programs. You can see the history goes back quite a bit, back to 1986, but let's focus on the recent few years. Again, we're looking at the US market, the US 500. You can see here that during the GFC, we had a considerable price drop, then it recovered, then let's look at the GFC first, and we'll look at COVID in a minute. So you can see here during the GFC, this program entered one, and this went over a couple of years by the way. It entered one set of 5 contracts there, entered another there, and then it closed out. So it made a nice little profit in a couple of years, but compared to this one, it made caused a lot more drawdown because we entered more contracts. So the end result was, you can see here, over the whatever that was, roughly 20 years of trading, this one made $13,400, or is making so far, based on this profitability. This one's making $12,200, and this one's making $16,000. So again, it's few and far between other trades, but I'm just demonstrating the drawdown impact. So where this is making $13,000, the detailed report shows the drawdown was $4,700. This one made a bit less. It made a bigger drawdown, which is not good for us, so $5,500. And this one made a bigger drawdown again. $8,300 was the drawdown. So the idea is, again, using this method, we want to calculate the percentage of the revenue over the drawdown. Now what I've done here as well, I've run these same programs, one over the indexes, the Aussie 200, the US 500, the China index, Germany, the DAX, etc. This one was done over a sample set of companies, such as Commonwealth Bank, Caterpillar, Woodside Petroleum, the other companies there, Woodside, CBA, BHP, Johnson & Johnson, etc. So just a handful of companies. And the last one I did a comparison against some currencies. So those currencies were Aussie US, Euro US, British Pound US, and so on. Just a sample, random sample of currencies. Why have I done that? Well, I want to see how those programs worked for each of those charts. And one thing to remember is every chart is like a fingerprint. It's its own unique pattern. Sure, you get similarities in terms of price drops and rises, etc., but every chart behaves differently in some way or another. And that's why these programs differ to some degree in terms of their effectiveness. So you can see here the index, 389 program scored the highest percentage, followed by the 388 program. And again, those numbers are just what I named them. And this program scored the lowest. This is all for the indexes. So if you had to rank them in terms of scores, 3, 2, 1, that one scored 3 points, that one scored 2 points, and that one scored 1. The next set of, we looked at companies on the share markets. That program scored the highest percentage, although you can see that the drawdowns for all of them were higher than the revenue created. Whereas here, they scored above 100%, meaning the revenue was higher than the drawdowns. But anyway, that one scored the highest, scoring 3 points, second with 2 points, and third with 1 point. Lastly, we looked at currencies. That one scored the highest with 3 points, that one with 2 points, and that one with 1 point. So what I've done a little Pareto, said, okay, of the three programs, 390, 389, and 388, I simply added up all the 390 scores, added up all the 389 scores, then added up all the 388 scores. So basically, the higher the score, the better. So it came out, in this sample of testing, the 388 came on top. So again, during the GFC, you would have, back here, you wouldn't have been burnt as much had you followed this program for the US market. And let's quickly look at the some other markets. Look at the Australian ASX 200. So you can see here back in 2008, 2009, we entered at the peak back here for both programs. In this one, we entered a secondary entry down here based on our criteria on this particular program. So that was actually a pretty good trade. We held it for that long, and then we entered another trade there. This one you would have entered a couple of trades earlier, and a third trade at the same time we entered this second trade. The market went sideways. We exited the market here at profitability with 15 contracts. Remember, we were entering 5 contracts at each trade. This one you would have exited the market with 40 contracts. So yeah, the profitability is higher, but as we said, the drawdown was also higher. Let's look at COVID and how that was impacted. For all three programs, the market exited before COVID hit at the end of 2020, so we weren't in the trade there. And you can see here the entry was made at this point back in June for both those two programs. Remember, these programs, this first program and this third program, are using the same logic, except this isn't doing an average down. Hence, the average down method is required to help you space out at a tactical level where to enter a trade. You don't want to enter at every small spike, because that might get you in trouble later on. Okay, we'll talk about money management in a different video, but that's it for today in terms of averaging down. I hope that's explained some of the pros and cons, and why you don't want to open too many positions when the market's going against you. You want to try and space it out at strategic points where you can survive at any particular market price drop that may burn your bottom line and burn your pockets and your profitability. Okay, I'll speak to you next time, and have good, happy trading.